Welcome to NAIOP's Solution Series program titled Breaking the Gridlock, Strategies for Managing Distressed Real Estate Issues. My name is Sandy Hudson, and I will be your host. The Solution Series programs are available at no cost to NAIOP members. These mini webinars run less than 30 minutes, and the goal of each program is to provide you with some quick tips and insights, all types of positive strategies and tactics to help you succeed in today's tough business environment. We encourage you to drive the content. Please send us an email to solutions@naiop.org to let us know what topics and presenters you would like to hear from in future programs. Please advance to the next slide. Some topics require a more in-depth discussion than we can cover in a Solution Series timeframe, and for that, NAIOP offers 90-minute webinars. These webinars are fully interactive and allow you to submit questions to the presenters during the program. The next full webinar takes place on Thursday, April 7th. During this webinar, you'll hear the latest trends in the negotiation of tenant improvement allowances from a landlord and tenant perspective, as well as gain an understanding of how the cost of materials and labor are affecting just how far those allowances are going. The cost is $65 for NAIOP members and $95 for non-members. You can register online at naiop.org/webinars. Next slide, please. And now let's get on with our program. With us today is Louis Frost, Principal and Group Head of Real Estate Corporate Finance for KPMG. Lou's job responsibilities focus on mergers and acquisitions, security offerings and capital raises, restructuring, and general real estate advisory. Lou has closed approximately $25 billion in real estate transactions, including mergers and acquisition, equity offerings, and debt offerings. He has led deal teams responsible for bidding on companies and assets worth approximately $5 billion. Welcome, Lou. Thanks for being with us today.
Okay, well, thank you, Sandy. This is an interesting and evolving time in the markets. The markets in general, and the real estate markets in particular, are improving the last week in the stock market aside. That being said, there is a lot of real estate distress left to be resolved. To date, roughly $300 billion of distressed commercial real estate has hit the U.S. markets, and less than a third of that has been resolved or restructured. So today we're going to talk about some strategies for resolving and restructuring real estate distress. Notwithstanding the market improvements I cited on the prior slide, the relationship between borrowers and lenders remains fragile. In the current market, increasingly borrowers and lenders are adopting a proactive approach to renegotiate the terms on distressed or maturing loans or exit deals on mutually acceptable terms. Having a successful negotiation often depends upon understanding certain key issues and the context in which the negotiations are occurring. A few of those issues are referenced on the next slide. And I'm going to focus, for purposes of the slide in this box, right over here. But lenders and borrowers should consider what flexibility from a financial and regulatory standpoint the lender has to restructure the terms, or does the lender need to exit the credit? And it's interesting, as we talk about this bullet point, last week the SEC announced that it was investigating certain community and regional banks engaging in what's been referred to in the media as extend and pretend, or some in the media have referred to it as delay and pray. But understandably, in the wake of this announcement, some institutions have taken a much more conservative approach towards restructuring debt. Not to say that this will necessarily impact your personal situation, but I think it's very helpful context to consider. Another factor is the borrower a valued client, and what is the relationship with the lender? It goes without saying that to the extent that you as a borrower have a strong relationship with the lender and or the possibility for repeat business exists, renegotiation and restructuring efforts will be much easier. Similarly, if the asset in question is a core asset of the borrower, and there is liquidity available to recapitalize or reduce the lender's exposure, these are very positive things from the standpoints of facilitating a restructuring or renegotiation. One factor that isn't specifically referenced on this table is the tax consequences of the proposed structures being utilized. And we'll talk much more about that as the presentation continues. But all of these various factors help inform which structure makes the most sense. And a couple of the structures we'll be talking about today are referenced on the left-hand part of this page. As these considerations suggest, there's no one-size-fits-all approach to renegotiations and restructurings. It really depends upon the circumstances, although we do see a few key themes come up time and time again. For borrowers, the key theme is the ability to maintain control of the asset and securing the time needed to potentially turn the asset around. For lenders, the focus is on transforming a potential non-performing credit into a performing loan, and if possible, maintaining the relationship with the borrower. And both parties are focused on the possibility of eliminating foreclosure risk. A few of the structures that we have seen get some traction in the marketplace are referenced on the next slide. We'll start with the AB note structure. And essentially what this involves is breaking an existing note into two separate tranches. An A note, which is currently serviced for debt service purposes, and a B note, which provides recovery to the lender in the event that the marketplace improves. A similar structure, but one much more focused on equity participation, is the HOPE note or equity participation structure. And here again, the lender is reducing the principal or changing the terms of the existing note in exchange for a piece of any upside value at sale. A third structure, and by far I think the one that lenders would prefer of these three, is providing alternative collateral pledges to the lender. And here the concept is that these pledges are provided by the borrower to shore up equity deficiencies in a property. Regardless of this specific structure employed, it's important to consider tax consequences, and those are addressed on the next slide. There are two principal tax considerations that we'll refer to in this presentation. The principal one, and the one that is probably most concerning to the clients that we work with, is the cancellation of debt. And essentially, when a borrower negotiates a reduction in the principal amount of the debt from a lender, he or she may recognize taxable COD income. And what's interesting is that this is true even if there's only a significant modification with respect to the credit. Also important to consider is that if the modified loan is subordinated to equity, or the lender receives equity participation rights, the lender may be viewed as acquiring a partnership interest for tax purposes. There are a number of exclusions from the events that trigger COD income, and those include bankruptcy, insolvency, certain farm loans, and real property business indebtedness. As is true with much of the tax code, this is a very complicated and very fact-specific set of issues. So I would encourage all of the listeners to retain advisors in connections with these issues to avoid costly and inadvertent tax exposure. Another strategy that has gotten a lot of traction is seen on the next slide. The joint venture new equity strategy. And probably not surprisingly, among the borrowers that we work with, this is unequivocally the preferred structure. Here, we're bringing in a new equity partner into the deal. And not surprisingly, what's really appealing to existing owners is that this essentially allows the existing borrower to maintain control of operations. It's appealing from a lender's perspective because the incremental equity may result in a reduction in the capital risk and provide a potentially stronger borrower on a performing loan. Important for the existing borrower to consider is that the new equity will often have a priority position over the existing equity, and the structure may provide accelerated repayment at specific specific operating milestones for the asset. The admission of a new partner could raise several tax considerations, and those are addressed on the next slide. The admission of a new partner essentially changes the economic arrangement of the partnership and, of course, needs to be reflected in the partnership agreement. There are two principal concerns from a tax standpoint. First, the admission of a new partner could also cause shifts in the allocation of the partnership's liabilities for tax purposes, which could result in gains for the existing partners. That is, a reduction in a partner share of a partnership's liabilities is treated as a distribution of money to that partner. And if the deemed distribution exceeds the partner's basis in its partnership interest, the partner will recognize gain. Another strategy is shown on the next slide. Discounted payoffs. And to be candid, this is a structure that we've seen covered much more in the media than we've seen actually executed by the relevant parties. A discounted payoff offer, or a DPO, is a proposal from the borrower or another friendly party to acquire the existing debt from the lender at a discount to face value. This provides a chance to reconfigure the debt on the property to a manageable level while providing the lender with an exit strategy. And here again, there are a couple of important tax considerations. First, if the borrower is a partnership, the admission of a new partner to provide needed capital in connection with a DPO may imply other tax considerations, as we talked about, other tax considerations related to partnership, as we described under the joint venture slide, which was the prior slide. And second, if the outside investor acquires the debt and subsequently contributes the debt to the partnership in exchange for a partnership interest, the partnership could recognize COD income if the value of the partnership interest issued is less than the adjusted issue price of the debt. The next strategy is one that we see a number of banks employing. This is the note sale strategy. We've seen a real sharp ramp up in note sale activity by financial institutions over the last 2 quarters. In fact, KPMG is currently in the marketplace with $140 million of non-performing loans and commercial real estate assets that we're marketing on behalf of a Florida financial institution. My view is that this strategy is increasingly common for 2 reasons, and the first has to do with price. I think increasingly there is a view that pricing has improved to the point that institutions are not selling at the bottom of the market. And secondly, as I referenced the SEC investigation regarding extend and pretend practices, I think the business decision has generally been made that there's a little bit more risk to restructuring than there is to a straight-out note sale. So I think for those 2 reasons, and maybe even there's even a third, which I'll reference in a second, but for those 2 reasons, note sales have increased substantially. The third reason that I just referenced is that there is a lot of capital chasing these kinds of opportunities, and frankly, not a lot of quality opportunities currently in the marketplace. Just to give you an example, for the process that we're currently running, we sent off a teaser to about 50 financial institutions and got over 21 positive indications of interest. I think part of this has to do with the fact that there is more private equity capital, hedge fund capital chasing real estate opportunities today than there was in 2007. And if you think about the level of transaction activity in 2007, that is a scary statistic. I would say, though, that with respect to this note sale approach, there is some real risk for the borrower. And that is that there is a perception, I think this is actually a partially valid perception, that a lot of the purchasers of these kinds of notes are what have been referred to in the media as vulture investors. And so one might reasonably expect that if one of these private equity funds or vulture investors acquires your note, the renegotiations and the restructurings will be done on terms that are much more advantageous to the fund. Again, I think my recommendation here would be that if there is the chance for a renegotiation with your lender, a restructuring with your lender, that is a much better alternative for the borrower than dealing with a private equity fund. Not surprisingly, when all the other alternatives fail, the financial institution will look to reclaim control of the property. I will say, though, we work with a number of banks, a number of financial institutions, and this is absolutely a choice of last resort. Financial institutions have neither the resources nor the interest in serving as property managers. So, I think this is a very favorable fact for borrowers. But again, I think in a matter of last resort, financial institutions certainly will push forward with foreclosure or alternative means of reclaiming the property. And we'll touch base briefly on a couple of those. There's foreclosure actions, deed in lieu, and a couple of other options as well. As it relates to foreclosure actions, once a borrower has fallen behind on payments and is unable to cure a default on the loan, the lender will file a notice of default, or NOD, and the notice of default protects the lender's interest in the property. Another approach that protects the interest of the owner in the property is a receivership, which helps to provide for the potential for, this strategy is employed when there is the potential for further diminution of collateral value. It's a rarely granted equitable remedy at law, and really is only employed in extreme situations where the applicant for the receivership can prove that there's an imminent risk of loss. Rather than foreclose, the next option on the next slide is very commonly employed, and that is a deed in lieu. The deed in lieu of foreclosure avoids having a record of foreclosure sale and may help to preserve the relationship between the borrower and the lender. So obviously, from the borrower's perspective, a very advantageous thing not to have a record of a foreclosure. The perception, I think largely the reality, is that a deed in lieu of foreclosure is often a more cost-effective and faster option than foreclosure proceedings. Now, with that being said, I think it's important to recognize that a deed in lieu of foreclosure effectively involves negotiating a purchase and sale agreement. And for those who have been involved in that type of process before, those contracts can be fairly challenging and time-consuming to negotiate. But again, I think overall, a deed in lieu is a more cost-effective and faster approach than foreclosure. A couple of notes regarding tax considerations in connection with a deed in lieu of foreclosure. First, a deed in lieu is treated as a taxable sale of the property and may result in COD income and or gain or loss being recognized by the borrower. Second, the measurement of the gain or loss and the prospect that COD income could also be incurred will depend on whether the debt being forgiven is a recourse or non-recourse debt for this purpose, and this is addressed a little bit more on the next slide. In terms of non-recourse debts, the debtor generally will recognize gain or loss equal to the difference between the amount of the canceled debt and the adjusted tax basis of the property. For recourse debt, the gain or loss is calculated on the difference between the fair market value of the property and its adjusted tax basis. To conclude, this is an interesting time in the market, and what we've seen increasingly is that banks seem willing to negotiate and transact. I'd say, in light of the SEC investigation, probably a little more transaction than negotiation, but I think both remain an option. From my perspective, the best strategy for borrowers is to regularly and proactively communicate to identify potential issues well before they become potential impasses. Finding the middle ground between borrowers and lenders should involve careful consideration of the tax implications to both parties, among the other issues that we've referenced today. And a final consideration is that a qualified and impartial third-party financial and tax advisor can be invaluable in breaking log jams and enhancing the prospect of both sides realizing their mutual goal, which is maximizing asset value. So with that, let me thank you all for listening and turn things back over to Sandy.
Lou, thanks for a great presentation and for the strategies on managing distressed real estate. Our next Solution Series program will be available on April 12th. Watch your email for NAIOP Source, our corporate e-newsletter, for the program link. Thank you for listening to our session, and goodbye for now.